Every year, somewhere around April, you hand a chunk of your paycheck to the federal government. The top rate on wages is 37%. Before state taxes, before the separate payroll tax that comes out every single pay period regardless. That's just the federal income line. On top of that, employees pay 7.65% in payroll taxes, Social Security and Medicare, and their employer pays another 7.65% on their behalf. The employer's share doesn't show up on your stub, but it's still a cost of employing you, still priced into what you're worth. You follow the rules, you pay your taxes, you do everything right. There is another set of rules, legal ones, and almost nobody told you about them.
As of 2022, billionaires and centimillionaires in the U.S. collectively held at least $8.5 trillion in unrealized capital gains, profits on stocks and assets they own but haven't sold yet. That gain exists. It's real. They can borrow against it, live off it, build dynasties off it. More than half, 56% of ultra-wealthy households' total wealth is made up of untaxed gains. For the average American household, it's less than a quarter. By the end of this, you'll know why that gap exists and why the people who built the system put it in writing.
Here's the thing that doesn't add up. From 2014 to 2018, the combined wealth of Elon Musk, Jeff Bezos, and Warren Buffett grew by $137 billion. Their total reported income to the IRS over that same period, $5.7 billion. About 4% of what they actually gained. You might think wealthier people pay higher rates. That's how a progressive tax system works, right? IRS data shows that taxpayers earning between $2 million and $5 million paid the highest conventional effective rate, about 27.5%. Above that point, the rate goes back down. By the time you reach the top 0.001%, roughly 1,400 people, each reporting income above $69 million, the rate is 23%. Past a certain level of wealth, income tax is less of a bill and more of a suggestion. The question isn't whether this is fair. The question is how it works. The U.S. Income Tax Code taxes different types of money at different rates, and wages are at the top. Long-term capital gains, the profits on assets held for more than a year, are taxed at a maximum federal rate of 20%. Wages face a top rate of 37%, a 17-point gap by design. But the real advantage isn't the lower rate. It's that you only pay it when you choose to sell. You can own $1 billion of stock that gained $900 million in value and own nothing, as long as you never sell. So what do you do when you need cash? You borrow. The IRS does not treat borrowed money as income because the borrower has an obligation to repay it. Borrowing against an appreciated asset produces no taxable event, regardless of how much that asset has grown. J.P. Morgan's Wealth Management Division publicly explains the strategy on their website. Step 1, buy appreciating assets, stocks, real estate. Step 2, borrow against them. Step 3, hold until death. At death, heirs inherit at a stepped-up basis, and the lifetime gain is gone. That last step is the hinge. Under IRC Section 1014, when an asset owner dies, the cost basis of inherited property resets to its fair market value on the date of death. The entire lifetime gain is erased for capital gains purposes. Heirs can sell the next day and owe nothing on a lifetime's worth of appreciation. Think of it like a bakery. The cashiers, the wage workers, pay full retail for every loaf, plus a Social Security charge on top. The owner of the bakery eats as much bread as he wants for free, as long as he never cashes out his ownership stake. And when he dies, his kids inherit the bakery at today's value, owing nothing for all the bread he ate on the way there. 3 moves. Buy, borrow, die. J.P. Morgan put it in a brochure.
The rule that makes all of this possible, the realization principle, meaning gains aren't taxed until you sell, was not designed to protect stock portfolios. The Congressional Research Service confirms it solved a real administrative problem. How do you tax a gain on a farm or a private company that the owner can't easily liquidate?
Forcing someone to sell shares just to pay a tax bill on those same shares is effectively a forced divestiture. The rule made sense for illiquid assets. It just happens to be incredibly generous for anyone sitting on publicly traded stock, where you can sell a few shares to pay the bill any Tuesday you want. That's the gap where the comedy lives. Congressman Cordell Hull, later known as the father of the income tax, saw it coming in 1920. After a Supreme Court ruling that year, he warned that wealthy industrialists could build a company, borrow against the stock to pay living expenses, and live upon the value of their stock without selling it, and of course, without ever paying tax. Congress has repeatedly proposed reforms, taxing unrealized gains at death, repealing the step-up, and repeatedly failed to pass them. As of mid-2026, the strategy remains intact. Hull predicted it. It took about 100 years to fully exploit, and the bank has a brochure ready.
Here's the number. ProPublica analyzed IRS records and found that the 25 wealthiest Americans paid an average federal income tax rate of 15.8% on their reported income from 2014 to 2018. A single worker earning $45,000, once you count income tax plus both sides of the payroll tax, paid a total federal rate of about 19%. The secretaries won, at least on the conventional measure.
The conventional measure is already absurd. The unconventional one is something else. A 2021 White House analysis estimated that the 400 wealthiest U.S. families paid an effective federal rate of just 8.2% once you count the income they actually lived on, including the gains on assets they never sold. The authors themselves said the true figure could be as low as 6% or as high as 12%, depending on methodology. ProPublica found that Warren Buffett's wealth grew by $24.3 billion between 2014 and 2018. His taxes paid over that period, $23.7 million. That works out to 0.1% by ProPublica's measure of taxes paid against wealth growth, not against conventional income. In 2015, Buffett's reported adjusted gross income was $11.6 million. That year, at least 14,000 U.S. households had higher reported incomes than Warren Buffett. His estimated net worth that same year, somewhere around $65 to $70 billion. The Social Security payroll tax only applies to the first $168,600 of wages in 2024. A $50,000 worker pays it on every dollar. A $5 million earner pays it on about 3% of their income. Jeff Bezos paid no federal income taxes in 2007 and again in 2011. Elon Musk paid no federal income taxes in 2018. ProPublica confirmed this from actual IRS records. Their spokespeople said they paid everything legally owed. Everything legally owed. That phrase is doing a lot of work. The rich do pay more taxes in raw dollar terms. That's true, and it should be said out loud. At 15.8% of $1 billion, the dollar amount is larger than 19% of 45,000. The rate argument and the dollar argument are different arguments. Both can be true at the same time. None of this is cheating. That's the whole joke. J.P. Morgan's Wealth Management Division explains buy, borrow, die on a public client advisory on their website. It's legal, documented, and openly marketed by the same major banks that hold the loans. ProPublica notes that the ultra-wealthy avoid income in the form of wages, taxed at 37%, and instead generate most of their money through capital gains and dividends, taxed at 20%. It's not a secret. It's a preference revealed by the rates the code itself set. When the estate is eventually settled, outstanding loans are typically repaid by selling some of the inherited assets at their new stepped-up basis, meaning heirs can cover the debt with little to no capital gains tax. The loan gets paid, the gain was already erased at death. Clean. The tax code rewards owning things. It penalizes earning things. That distinction was written into law, has been tested in courts, survives every reform proposal, and is now explained on bank websites. Cordell Hull saw it coming in 1920.